All right. So what we're seeing here is broker-dealer financial assets. Well, you're seeing the growth. This was a recession, so they couldn't grow, or we call it, that no one calls it, ballooning their balance sheet. You see that they've been generating extra 300 billion, and the 2006 600 billion was the classic blow-off of this whole broker-dealer financial assets. So let's move on to the next. All right, so this is the year on year. It looks like it's the same chart. Let's move on to the next. All right, this is not macro fundamentals. It just happens to be alphabetically in this order, but I'm going to spend a little bit of time. If anyone catches the big mistake in the chart, whoever made the chart made a great job, but made one big mistake. So what this is showing you is the typical or classical cycle, bull market cycle, with a mania phase. You see the stealth phase, so the early phase, sometimes they call the stealth phase, which is only smart money accumulating. You see in the second phase, you got the institutional investors, and then you got the public, also known as the herd. So, smart money, big money, and this. Now, what you see here is the takeoff. Now you have here somewhere a first sell-off and a bear trap. Well, what is a bear trap? Bear trap is actually a poor terminology. Bear trap, let me show you okay, so bear trap, and this would be a bull trap here. This is bear trap, guys, not this. So let's explain a bear trap. A bear trap is when the bear or the bear market keeps falling and falling and falling, and after it has fallen for a while, it provides a run-up, giving a new hope to the bulls. So the bears set up a trap for the bulls, and the bulls jump into the trap on the way up, believing that there is a return to normal. So usually a bear trap occurs in bear markets, and the idea of the trap is that the bears allow the market to run up. Well, this means that the bears shorted at the top, big time. So when the market collapsed a lot, the bears would be covering their shorts. And the covering of their shorts will drive the market up. But it will give what's known as false hope to the bulls, and the bulls will re-enter in the hope that the bear market is over, meaning that this was not the beginning of the bear market, but only a correction of the bull market, and the bulls believe that this is the resumption of the market, of the bull market. Well, they fall into a trap, and then the market collapses big time. So you have the initial takeoff. Well, that will be a bear trap, but this is not how it's called. If you would remember Richard Russell, what was Russell saying about this particular, it's called a shakeout. It shakes out the weak bulls. In other words, market went up here, and here on the run-up initially, it got in a lot of speculative fraud. So a significant sharp drop will scare out all those that do not have faith in the bull market. So it's going to shake him out. So the idea of the bull market is that it carries on the way up as few people as possible. Remember that saying? And on the way down, it's trying to carry with it as many losers as possible. Well, this sell-off here will shake out those that are not believers. So every time you have a major sell-off in the market, as in gold, oil, wheat, whatever, they are saying, this is it, this is the bust. The bear market is over, and a lot of people that do not believe in the long-term bull market, secular bull market, sell out completely and get out of their positions, and the bull market then resumes on the way up with a whole lot less people on board of the market. So now you have media attention. I would say that the media attention is a little early. It is somewhere in here is the media attention, not as late as over here. Now the media attention is here. Over here, I wouldn't say media attention. It becomes, there's a difference. Media preoccupation. The media is preoccupied. Every day they're going to be talking about .coms. Every day they're going to be talking about telecoms. Or every day they're going to be talking about housing and housing construction. Now I'm seeing the media preoccupation, but on the bust side with financials. Every single day for the last year, essentially over the last 2 years, they've been talking about financials, 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 like they were talking about .coms, all right? So over here is the media attention, over here is the preoccupation. Now you get the enthusiasm. Everybody's enthusiastic. As, let's say, Bulgarians were in 2004 and 2005 about real estate. We were supposed to get in 2007 in the European Union. So the enthusiasm in 2004 and 5 was everywhere. I mean, everyone was telling me that real estate is the greatest investment of all time. All right, that's the enthusiasm. Then, once you see the substantial rises in prices, greed takes over. So suddenly, of course, this enthusiasm turning into greed with an almost vertical increase in prices is associated with one key characteristic of any mania, of any speculative mania, and this is leverage. Suddenly, when enthusiasm turns into greed, greed is always associated with leverage. So everyone now being greedy and making lots of money is eager to borrow as much as they can in order to, get rich as quickly as possible. At the very here end, so close to the top, you got the delusion. The delusion. Everyone is deluded that real estate prices will never fall. It is most amazing, even today, I keep hearing every single day in Bulgaria that real estate prices won't fall. Everyone admits that at the Black Sea they are falling, and in April and a whole bunch of other ski resort areas they're falling, yet real estate prices, and they say residential will never fall. Well, this is an example of a new paradigm. In other words, people's beliefs change, and this is where the paradigm is. As there is a collapse, it was seen in the U.S. real estate. U.S. real estate has been collapsing since when? Since late 2006, or maybe mid-2006. By the middle of 2007, everyone was in denial that this was even possible. I mean, how could it be falling when it's impossible to fall? And then, of course, you get the, interesting, they call it here a bull trap, but this is a bear trap. It's interesting how they call this bear trap, bull trap. I personally have studied it and understood it as quite the opposite. This is a bull trap here, and this is the bear trap. Anyway, be aware that there is a difference in terminology. So now everyone says, oh, we are returning back to normal. And then you see the second leg down here, and then you have the capitulation. And after the capitulation, you also have this forced selling or forced liquidation, which is associated with despair. One of the most important characteristics in bubbles that you have to understand, which historically has been repeating over and over and over again, the most important lesson to learn is that in the bust of the bubble, you always overshoot. Overshoot means that no matter where it started, you have some long-term trend, maybe 2 or 3% growth trend or whatever, and you are going to certainly give up all the gains during the whole bull market and then you're going to give up some more and then get back to the trend. So what they are telling you in the hope that, well, real estate prices went up like 3 times, and they're just going to stay up 3 times for 5, 10, or 15 years is extremely unrealistic if it previously was in a bubble mode. When you get a bubble and you get the bust, it has got to go all the way to the very long-term trend and then some more. And this is in the nature of bubbles. That's one of the most important lessons, which is simply never understood. So now the hope is, well, yeah, it shot up real estate in the US. It has fallen 10 or 15%. It's over, and now we're just going to stabilize. What is the meaning of stabilization? The meaning is that somewhere over here we're going to terminate prematurely the capitulation of the market. The market's going to stay flat for as long as necessary so that the long-term trend catches up. Well, this is at best hope. It is certainly not substantiated by history, and this is something you shouldn't rely on. And of course, policymakers shouldn't rely on. All right? Any questions? Well, did anybody catch where was the other big mistake? Big mistake is here, blow-off phase. Blow-off phase is the same as the mania. So the mania phase, the blow-off phase is the vertical takeoff here is the blow-off phase. This phase is the bust. Alright, so the blow-off phase is sometimes called, is associated to be equivalent to the mania phase. Sometimes the blow-off phase is the latter part of the mania, the second part, or the last third of the mania. Any questions on this chart, guys, before we move on? Any? None? Oh, okay.
Is there a situation where we don't have the bear trap?
The what?
The bear trap.
Almost no. Very rare. That's one of the classic examples or periods that separates out, in English we call it punctuates, the first phase of the bear market from the second phase of the bear market. So the first phase of the bear market is this. This interrupts, and then you have the second phase. Now, let's talk about the Russell interpretation, some of the other guys of the bear market with the stock market. What their interpretation is that 1999-2000 was the peak top up here. From 2000 to 2002 was the first leg down. What their hypothesis was that this here will last for maybe another 10, possibly 20 months, and then they were expecting a major leg down. As we get to reread and reinterpret now history that we've gained, some more time, so they were talking about 2004, and now we're in 2008, it appears that this bear trap is, at least the modern interpretation, has been a 4-year long bear trap. So for 4 years, it was necessary for 4 years to have everybody's confidence to be regained and to get them again in the bull market. In 2007, the credit crunch in August would be considered the peak of this 4-year bear trap in order to get on the way down. Well, here's another thing. The longer the bear trap, the more vicious the collapse afterwards. That's also a classic interpretation in general. All right, more questions.
The opposite question. Then can we have a sequence of small bear traps?
Yes, the answer is yes, absolutely. There were 6 in a row during the Great Depression. 1929, first major leg down. Wall Street said, it's over, it's the end. Now we're back in bull mode, and roughly, the bear trap lasted 3 or 4 months. It was over, meaning it's called, in English, it's called it fizzled, and then another major leg down. Then Wall Street said what? It's over. No more. The pain is over. We're finally back to normal and all the good stuff. For 3 months, it allowed to regain confidence, and then boom, the third one was really devastating. Then again, 3-4 months rally, bear market rally or a bear trap. And again, another fourth leg down. Wall Street on the fourth leg down said, well, we were wrong for 3 times, but this is it. This is the ultimate bottom. And it's a whole different story I don't want to get into today. I've been reading the Wall Street Journal from 1929 to 1932. This is the one thing, again, that if you guys ever get into the investment world and ever get into the trading, you have got to go and read the Wall Street Journal from 1929 to 1932. At least that investment market page that tells you what's going on. And usually the journalists will say Wall Street has a unanimous consensus that the bottom has been reached, and only a few people will disagree with them, so-called students of Dow theory. All right? So, well, then what happens, of course, is another leg down, and then another leg down. So, ultimately, when the bottom hits in, that will be July 1932, you should be able to guess what's happening. Wall Street, right at the bottom, says, it is not a good time to sell now, but when the market rallies, use opportunities on the rally to liquidate your stocks. Well, why can't you liquidate at the bottom? The answer is the market has been down already over 90%. There is extreme illiquidity, which is also a result of forced liquidation during 1932. Lots of banks went bankrupt, so there's been a lot of forced liquidation and no buying power, so that's why prices are collapsing. Well, then the Wall Street Journal says in a passing note, as if it doesn't mean nothing, that now at this point Dow theorists, the students of Dow theory, believe that this is the ultimate bottom and that the 4-year bear market is over. Wall Street, of course, again disagrees with them, and now Wall Street, after 4 years of bear market, they have been bullish every single step on the way down. Now, when you reach the bottom, Wall Street thinks that the bear market will continue. And this is exactly the time that you reach the bottom itself. So, usually, the best way to read the market is to read about the Wall Street consensus and assume that it is wrong, because 99% of the time it is wrong, and that's the best way. I mean, that's how I usually get to know what's going on in the markets, is just turn on CNBC. Once I get to feel there is a good consensus, then I know that, it is not what it is. Oh, Tuesday, well, of course, that was yesterday. Bear Stearns, everything was fine and everything's dandy, and the market has been going up for 5 days in a row. Can you imagine? That's for the last 8-9 months, ever since the credit crunch has begun. 5 up days in a row for the stock market has been phenomenal. And guess what? They said it in the same words like the 2 Johns. The guy just said, happy days are here again. We reached the bottom and now the good times are bad. Yes, we may have to worry, and here's the guy saying, but bull markets climb a wall of worry. I think the troubles are behind us and investors should get in confidently. Whoops, when you get to hear guys like this and you get to hear a whole bunch of others agree with him, you gotta know it's not over. Alright? Let's move on. What do we have here? Fed government budget balance. Ooh, what is it? Billions annualized? Which year is this? This is 1980. Let's zoom in at 80 and goes all the way to 2003. And you see that the government has pretty much not balanced its budget. You also see that during a recession, this shadow, the dark shadow here represents a recession, okay? And here's another recession. So 1 in 80, very short. That's where, from the other course you might remember, 1980, Paul Volcker raised rates big time. But when the economy and the markets just contracted big time, he flinched. And they relieved the pressure by reflating. Well, the reflation essentially aggravated the problem. So in 1981, they had to tighten yet again. So then there was the big bust. The point is, recessions are typically associated with a major deterioration of the government deficit. So there was one here that's more interesting, 1990, but you can see here major stimuli, and you see surpluses. You get into a recession and a major 200 billion surplus evaporates with the stroke of a pen of the president. You know, just put in a stimulus, 300 billion. That's it. Everything that the country has worked for, let's say from 95 to 2000, so everything the government has presumably accumulated during those years, you know, a big stimulus wipes it all out and turns a, you know, major positive accumulated over many years immediately into a negative. Any questions? Any questions here? All right, let's move on. So, California condo prices, I think we've seen them before. December 95. You see, here's a median price. Why median and why not average prices? That's an important that you got to understand in general. The median price is the better and the average is not the better. But the question is why? You have to understand that one. And it is. You guys know, one of our lectures was posted on the internet in a blog. And they say, wow, these are great lectures and all this kind of stuff. And the other guy says, well, did you get a feeling that this guy is teaching zombies? Like, nobody says anything? I mean, the other guy said, well, do you think this was a real class? Or the guy was just, you know, talking to himself? All right, go ahead.
A median is not affected by outliers, so it's more.
All right, so that's one good way to say it, is not affected by outliers. Well, which are the outliers?
Well, extremely large or extremely small values.
All right, so which one will it be in real estate?
Locations, like...
Now, it's going to be, think of Hollywood superstars. I mean, they got like 10 million or 20 million houses, you know, on, what was that beach next to California. So they got this nice little mansion, $20 million. Well, the price of the average is 130. So you build up quite a few of those, and suddenly those extremely large, in extremely expensive houses, which are very small and few in number, will distort dramatically the averages. So the idea again is you can build one, let's say 10,000 of these, and if they're extremely expensive, they will push up the averages. But the median will remain almost unchanged. Alright, so the median is much more stable, and the median better represents the average American as opposed to the average, as opposed to the statistical average mean. So you see 125, you see rising steadily, you see in June it's reaching 225, so that's almost doubled. This is a correction here. Again, real estate prices never fall. Well, it is interesting how fast Californians forget, or how short their memory is. Well, from 225 in, what is it? How long is this period? Roughly 6 or 9 months, guys, help me here. It falls down to, let's say, roughly 190. So, from 230 to 190, the median price falls by roughly 40,000 in this area here. And this should represent, I'm looking from June to April, in 9 months. So, in 9 months, the average will fall on 230 basis. It will fall roughly 20%. This is a shocking fall. And yet, Californians just wouldn't notice it. And they say, real estate prices never fall. I mean, you guys understand what this picture says? That this is a journalistic type of BS, or realtor stuff. Real estate prices never fall. Well, that's not quite true, as you can get to see. Of course, you may have you may have seasonal ups and downs here, but this is not seasonal. This is the dot-com telecom bust of 2000, and of course it induced a recession, and because some of the beneficiaries during the dot-com telecom boom were Silicon Valley and Californians, then the bust affected them the most. Alright, so there is a very nice example. So from 200 they've gone up all the way to 300. Well, how much do you think they went all the way up to the top? Anybody? 550. So they almost doubled from September 2002. All right. So any questions on this chart before we move on? Any? All right. Let's move on. California. Oh, there you have it, guys. This is the continuation of the previous. So, starting here in 04 at 400, if you remember, they ended around 300 in 03. They go all the way to 600 in December 06. Well, this represents from 400 to 600, represents nice, good quality, 50% in from January 04 to roughly January 07. This is in 3 years. So in 3 years, you get a 50% return. And do you notice something else on the chart which is not easy to notice because you didn't get the arrow to point it to you? Anybody? Wow. You guys need arrows? Well, this part here, it falls precipitously. Zoom in, man. This is important. This is what the chart is about. Yeah. Come on, zoom in. This is what it is. We're talking about 570, and then it drops to roughly 520. We're talking about 50 billion average, and that should be in one period. Let's just call it a quarter, doesn't matter. We're talking about 10% wipeout of the value, and that's remember, California single family median house is wiped out in a matter of months. And you're told real estate prices never fall? No, when they fall, they crash. Alright, you got to understand that. It's a good lesson even for us Bulgarians, but again, we'll never learn it until the bust actually comes. Let's move on. So capacity utilization in industry. Alright, so this is again basic macro fundamentals. Capacity utilization is in percentages: 70, 75, 80, 85 or 90. So this represents the inverse. 1 minus capacity utilization tells you what is the free capacity of the economy. You see right before a recession, capacity utilization runs in the high 80s. And you get a recession and suddenly capacity utilization falls dramatically. Then utilization ramps up, and then you see again, that's the 74 recession. Again, a massive collapse in capacity utilization. Again, run up, mini recession here, and another 80 to a massive collapse. Again, it recovers up to 80 plus, and then falls. And then recovers and falls. Here. And here is an interesting part, is that capacity utilization cannot, looking from 1966 Of course, this is the so-called legendary what? Welfare, warfare state, you know. Capacity utilization has been ever going down. I mean, why the economy cannot keep its capacity up and running, utilized? What's the problem? Well, the answer is malinvestments. Each time you create the boom and the bust, you got some capacity and the economy is distorted. The economy really needs one thing, but instead it's got capacity for something else. So, of course, that capacity from something else is a leftover from the previous boom, okay? So, now you have, let's say, lots of dot-com, telecom overcapacity, which will not be utilized for another 10, 15, and possibly 20 years. It may take anywhere between 20 and 30 years to get back to fully utilize all of those fiber optic cables. So this indicates here a progressive deterioration or the accumulation of malstructuring of the economy, because as the economy begins to be booming again, it cannot reutilize fully its capacity. So you got here in 98, 99, you got here a very booming, hot economy, and yet you have a very low capacity utilization rate relative to the peaks of previous booms. Any questions?
How do they measure that?
Well, they simply measure, hey, I can produce 10,000 cars in my factory, but I'm producing 9,500. So I'm using 95% of my capacity. That's, of course, a primitive example, but good enough to illustrate how they think about it. So usually they have their rated capacity. I mean, for any type of manufacturing, of course, it's a sample of it. And based on the rated capacity, they also have the actual capacity. So it is a simple second grade math, well, currently third grade math of, division of two numbers. All right, more questions? None? All right. Well, thanks God, no zombies today. More questions?
What do you think is what is the major difference between the welfare years of the Johnson administration and now when, because we see that there is no such utilization now?
What do you mean the welfare year? I don't understand the question.
No, because you mentioned about the welfare years.
No, what I mentioned was that the economy started on a welfare warfare path. The guns and butter policy. And the guns and butter policy required necessarily massive inflation to cover the deficits. And the massive inflation triggered massive economic booms, which led consequently to busts. And in the boom-bust process, you had major leftovers of malstructure. In other words, you have some productive capacity which is not used. So this is the causal relationship. So every boom and bust turns out that the, policymakers do not allow the bust to complete the job so as to liquidate the malinvestments or the surplus capacity and redeploy it in a better manner, and they try to reignite the boom sooner, and the answer is you got more and more capacity which you can't use. Is this kind of answering the question? Okay, more questions.
Is that indicative of the relative strength of the economy, the capacity more or less?
Well, it is indicative of the current state in terms of the business cycle. But it is also the overall long-term trend is indicative of the overall strength of the economy. So, a good strength indicates a nice fluctuation close to the top and then to the bottom. Kind of like in a harmonica-like manner. But this one is downward trending, and it shows that there are major fundamental problems that are building up in the economy throughout the decades. Is this answering? So, what are we looking here? Total industrial production versus total utilization. So what they're showing you here is industrial production is going up and then going up. Let's see, plus, and this is this total industry capacity utilization. So sometimes when you get capacity utilization from this point of view, you actually get somehow the economy overheating. You got to understand, it is well accepted premise in macroeconomics, macroanalysis, that once the economy shifts to 95, 98, 99% of capacity utilization, the result is that the economy is overheating. One of the reasons is that you have little slack capacity if something goes bad. But the other bigger problem is that while you're using a capacity, it is very hard to do maintenance. One of the major problems today is in US refining. US refining has been running close to maximum capacity utilization for many years, I might probably say many decades. And in order to keep up with demand, they postpone and delay maintenance. Well, what you need is a relief from the maximum utilization in order to provide downtime, 3 months, 6 months, God knows, whatever the technology requires, to provide a full maintenance. You know, get rid of all corrosion in the pipes. See and check where the pipes leak. You know, refill whatever. If there are weaknesses and whatnot and cracks, again, solder them. You know, whatever is necessary to do. I mean, if you're using any kind of mechanical equipment for many years, you'd better do some basic maintenance. And that is one of the problems when you get to use. He's probably trying to tell us something, but I can't read what exactly it is. Let's move on to the next and see. Alright, Case-Shiller HPI. I think we did this before, right? This is about inflation and how real estate prices, and substituting instead of the real estate price, using owner's equivalent as the government does, grossly understates the true inflation. Alright, let's move on to the next. Again, this is similar year over year. I don't see much of a difference. Alright, so Case-Shiller home price indices. Let's see now what this is telling us. 1988, and this is 2006. And let me see, I'm trying to see the 10-city composite. Okay, so this is for only 10 cities. This is only for US national. This is for 20. And this is percent change year over year. So what this is telling you how fast real estate prices have been growing. Well, for example, 1991 was considered a real estate recession or real estate bust. You had, for a short period of time between 1990 and 1991, you had negative price growth. In simple terms, real estate prices were falling, all right? At least in these 10 cities and in the US national. And then prices ramped up and growth accelerated. So you had here like 8% growth, and then you reached 12, and then it peaked at 16% growth. And then you see how fast growth collapses to minus 4%. So essentially the point is from 2005 to somewhere 2007, you can see this thing here, which has been growing steadily, you know, whatever the acceleration is, can be lost in basically a year or 2 years, all right? This doesn't mean that prices return to the level of this time, not yet. Okay? But it just means that when real estate prices get to fall, you know, you could lose growth momentum extremely fast. Any questions? No? Alright. Alright, this is interesting. This I saved today. This is from today's chart. I was reading some stuff, whatever. Found, oh, great stuff. So, this is Case-Shiller price indices, and he's using roughly the 87 as a benchmark. And if you can see, the blue represents the Chicago, San Diego, Comp 10, will be the green, and is this the red comp 20? That's not the red, that's the yellowish comp 20. So you can see composite, these are 20 big cities, and you can see that you could pretty much say that, and here's another important piece which I missed. Inflation adjusted. So these are in real terms. So when you subtract from real estate inflation, government inflation, you get from roughly 90 or 100 all the way to 99 or 2000 for roughly 13 years. Number one, you get very little gains. Is this one fairly clear? So, real estate isn't growing up a lot or much or anything relative to inflation, in other words, in real terms. Of course, what you gotta understand here is that real estate is adjusted for official inflation, which of course is understated. So, if you actually use real inflation, what would the picture look like? Well, it will trend a little bit downward. So, in real terms, real estate is just good enough to keep up with inflation. A nice way to say it is that real estate is a good inflation hedge, but it provides poor investment returns. Now, the bubble here can peak all the way, and you can see for that particular red one, San Diego area, you can see the prices literally went up and shot over here, and the idea, the article was, hey, if real estate is going to be coming back to normal, it should be coming back to around this level, and the talk was that from an average of 150, well, some are a little bit higher, some are a little bit lower, getting back close to the 100, real estate prices will have to fall at least, what is it, 20, 25% from here to normalize. So, while some people are saying, well, real estate has fallen already 20%, we are, they call it scraping the bottom. The article today is saying, oh, no way, we're nowhere back to normal. Now, the Peter Schiff argument is, hey, if the mortgages are selling for half the nominal value, the face current value, then probably real estate's got to fall 50%. Well, where is the difference between, let's say, 30% fall from here, from this point of view, and 50% from the Peter Schiff point of view? Where? How do we explain this difference? Well,
Inflation.
No. Overshooting. All I said was from 150 going back to normal. But they rarely go back to normal. They overshoot. You gotta expect it to go down here to the 90 area or maybe 80 area before it gets to recover, okay? So if you actually get to look from, let's say 150 down to the 80 area, there you have it, 50%, all right? So they gotta fall another 45% if you just want to overshoot some, all right? Any questions? So this is nowhere near the bottom. Let's move on. CBOT metals complex. Oh, okay. Well, this tells you essentially the rise of commodities trading from 2003. You see how in 2004 commodities trading has been increasing, and then suddenly in May 2005 commodities trading is literally skyrocketing. Again, metal average daily volume. It simply says the number of contracts that were bought and sold on any given day, and these are averages. So essentially it tells you, hey, apparently there is a strong, a rapidly growing interest in commodities, whether real estate, real investment interest or speculative interest. Some have been arguing, one of the most renowned scholars and researchers although he's part of the central banking cartel, Frank Veneroso, he's been claiming that these spikes here, and especially the last one, are definitely part of hedge funds, leveraged speculative positions, and removing commodities off the market so as to artificially boost returns, boost prices and therefore returns. Again, whether it is true or false, it provides food for thought, and seeing spikes like this should tell us there is either some type of crisis buying. Well, what might be the crisis buying? Well, collapsing dollar and using commodities as a currency hedge, or rising inflationary expectations and using commodities as an inflation hedge, or some other, I don't know, could be of course speculative hedge buying. But something's going on here, and any analyst should be looking a lot deeper to find an explanation, because it just doesn't rise relative to 2004. See, from 4,000 to 40,000, volume would not rise 10 times for nothing. Again, you could crank out all the econometrics and all the curve fitting, but you gotta get back on the ground and see who the heck is buying and why, alright? And no amount of econometrics is going to help you, unfortunately. Alright? Any questions here? So what they're saying is, hey, speculative fever is brewing in the commodities market. Alright, let's move on. What do we have here? Crunch time. Oh, let's skip this. This we'll study in my other course on the credit crunch. Chart, prices of US subprime. Oh, okay, this is a great chart. It is good for the other course, but while we're at it, I'll explain it succinctly. You deserve it. Well, these are, first of all, subprime mortgages. Subprime mortgages were securitized in different, so there will be CDOs or MBS or whatever, securitized and collateralized, and they will have different tranches. And you're going to get the AAA tranche and the AA tranche and etc., etc. And then at the bottom you're going to have the equity tranche, which will be supporting the value of the others. The most instrumental of this securitization process, the crucial piece, is credit default swaps and credit derivatives. So yesterday I was teaching credit derivatives are technically not structured finance, but they were the most important tool that supported structured finance because it provided guarantees and insurance on the structure itself, meaning on the different tranches of the structure itself, especially the AAA pieces. Well, now you get to see this color over here, how it is falling, flat, and then you get the credit crunch and the price goes down to, what is this, 90? So, suddenly, turns out that AAA, investment grade quality paper, all the great stuff, sells for 90 cents on the dollar. Well, 90 cents on the dollar, you can compute the yield, but if you get, let's say, AA, and look that AA sells like 75 cents on the dollar, so the price collapsed from 100 to 75, the imputed yield will tell you that this is junk paper, meaning the financial instrument is considered by the market at this pricing a junk instrument. Well, what else? You get to see some of the lower tranches, lower quality, like BBB and BBB minus rated, from 100, and they were trading close to 100, it fell down to less than 30, like 28. What it means is that it had lost over 80% of its value. So, if you had this type of paper, if you had, let's say, 200 billion of these, suddenly 160 billion would simply vanish, evaporate. Someone's got to take the loss. So this gives you the problems with the valuation. Now this is the February crisis. February crisis was the first time that the subprime crisis flared. There has been some recovery. This is a classic bear trap. This is a price. So this is the price that these securities trade at. So there was a collapse, bear trap, and then another one. I mean, I can discuss some more about it. I don't want to get into this now. Let's move on further. What is this showing? Let's see, scroll up. Currency composition of official foreign exchange reserves. Well, these are all countries. Well, I'll skip this part. This is part of the international finance course. Let's move on to the next. CEO Business Confidence Survey. So, in the US, like many countries, it is perfectly normal that you call up the CEO. Well, they know that they'll be called up as part of a national survey where they call them up and say, how do you feel about your business? Do you think your business has been improving over the last 6 months? Do you expect your business to get better over the next 6 months? How do you see the economy? A whole bunch of questions. And because they ask pretty much the same questions, they allow for some meaningful comparability of the answers. Well, CEOs are considered to be some of the smartest money. At least they see what's on the ground and they can determine best, at least earliest, if trouble is on the horizon and they're showing any caution. Well, you see here's a recession and you see that businesses were, at least, I'm not meaning businesses, I mean business CEOs, right? The CEOs were losing steadily confidence on the way to the first recession in '82. Suddenly they regained confidence, of course, incorrectly. They were fooled by this reflation and they lost it again. Of course, bad times were here again, they were doing well, but somehow from 83 to 90, they weren't feeling great about it. These were fairly good times, but for some reason, whether they had their own biases, whether the reality of the economy was bad, whatever the reason, suddenly their confidence fell. Again, after the 90, it recovered. Again, it was moving steadily slow. And now you see the dot-com telecom here told you that the US economy is in recession. And what is this chart all about? What is this chart all about? Okay, well, yes, this is CEO executive sentiment. But this chart ends roughly in 2007. It's a fairly fresh chart. They wanted to, if a macroeconomist showed, financial market analyst showed this up and wanted to tell us something about the economy, what was it? That CEO's confidence going down in the 30-40 range here, and here is indicative of recessionary expectations. Moreover, it forecasted that recession is on the way. Well, where is CEO confidence now? 39. So what this guy is telling you, and this is probably one of the best examples of macro analysis, what this guy is telling us, hey, in 2005, you have rapidly deteriorating CEO confidence. And now CEO confidence is telling us that the economy is moving towards recession or into a recession. Well, why this whole talk about the recession? Well, you always see a major drop of the market during recessions. The average drop is anywhere between 20 and 40%. That's historic lesson, and it's easy to observe over the last 200 years. So if on average you'd expect 25-30% drop, and now, oh, we're approaching recession, we'd better nail the top, and then discount 20-30% as an expectation for the return of the market during a recession. So if the top was 14,000, it would be nice to say, hey, the market's going to bottom around 10 or 11.
So how do we explain the decline in the late 90s, since that was the time of the boom and their high confidence in the beginning of the 90s?
You mean here?
Do you mean that they can...
Well, tell me which year you mean, because just 90s...
Well, there is a decline after 95, so this is exactly...
Yeah, 96, well, they may be, it was a decline, but it was a false decline. Yes, there is a possibility that you may get false declines, that's true. Now, here in 94 is associated with a crisis. Alright, it was an international Mexican crisis and currency crisis, all sorts of problems. Wall Street had some problems, so that's a problem. Now, what about 97 here? Well, what about 97?
Russian.
Well, you had the Russian, well, the Asian crisis, which later on moved and became the Russian, and then the... Remember, 97 was a collapsing dollar, and the, well, in 87 was the stock market crash, the Asian crisis. So, there you have it, guys. So, it tells you something's wrong, 97. Well, again, here it was bad. Again, it doesn't mean you get a 100% sure answer. Well, anyone would wish that be the case. But it's telling you, hey, we gotta be watching this, and probably the economy is moving towards recession. It's a nice macro indicator, because if the economy is in recession, you'd better be shorting the market. More questions. 87 is the stock market crash, but it doesn't show here. Let's move on. Alright, China, corn domestic usage. Well, this is again part of fundamental analysis, not very interesting, but you can see the Chinese, especially since over here, have been steadily rising their corn usage. Not very interested for macro analysis of what we're doing, but possibly interesting for, let's say, investing in corn. If you're, investing in corn long term, this is a helpful chart to give you understanding of what might be driving world demand for corn. Let's move on to the next. What is this now? Export mania, the route to a market economy. What is it saying on the top? China exports. Alright, so, well, this is more global stuff, but it's nice to see China has been rising steadily, 92, 3, 4, 5. Well, the interesting part to understand, guys, is that China began to be the talk of business, financial media, and experts when? 2003, 2004, possibly 2002, 2004. Roughly over here, with this spike, initiated massive media coverage. Well, what you got to understand that the trend was in place steady for 10 years. A lot of the top guys in the world, like Mark Faber, like Jim Rogers, they were talking about China all the way throughout the mid and late 90s. Mark Faber published his Good Tomorrow's Gold, which was not about gold, which was about China's rise as an economic, empire that will overtake economically the U.S. Well, he wrote it in 1999 2001, early on. He wrote it that China will be taken off. So, what I'm trying to tell is that you have a lot of smart guys who are seeing the trends 5 to 10 years before the media even begin to talk about it, and this is exactly how it works. I mean, 2004, who else in Bulgaria wrote about real estate bubble? I mean, they found it interesting and at that time curious. It was a curious way to look at it, is to say in 2004, December 2004, December 27 is when I published it in newspaper Capital. There are interesting way to look at things. Of course, no one even bothered to consider it seriously. That would be, too outrageous. All right, let's move on. So this is the US dollar to the Chinese yuan. Well, this is also important for regular investment course, not only for my other international finance. Basically, what's telling you is that since 2005, the Chinese government has been steadily, slowly but steadily devaluing the dollar. The correct statement is revaluing the yuan, and it takes more and more dollars per yuan, or it takes less yuan per dollar. And you can see that from 8.3 to 7.5, that's roughly almost 10% devaluation in, 2.5 years. So the Chinese are devaluing. They don't have a choice. They just want to have it done at a moderate pace. Any questions here? None. Let's move on. Guys, you gotta tell me what's the time. Is it time now? Alright, so Nick, let's remember what commodities open interest. So this is what reserves